Hi, I'm Tom Thornton with Hedge Fund Telemetry, and today on Real Vision, I have one of my heroes, a technical hero, John Bollinger of Bollinger Capital Management, and the founder and creator of Bollinger Bands. So John, thank you for being here in New York City.
Thank you for having me on.
And I know a lot of people are very excited about this interview. First time on Real Vision, and I'm thrilled because I'm a technician, and you have one of the best indicators that so many use. And we've had this conversation earlier about how you developed your indicator, and it's a creative process that I think is rather unique. And also, it goes back before computers. So why don't you talk a little about that?
So I started right at the juncture of hand-driven analysis and computer-driven analysis. Of course, we had things like HP calculators and such like that to aid in the process. But when I started, we mostly calculated indicators by hands. We kept trading blotters, big, like accountant's pads with a row of dates and times down one side and rows of prices of various instruments we were interested in, and then the various indicators. And we didn't calculate many indicators because it took a long time. But one of the benefits of doing that is we got to know those indicators intimately. We really understood how they behaved in different phases of market action. So as we made the transition to computers, that knowledge gave an advantage to those who then were able to take advantage of the speed and power of computers, because we knew what to tell the computers to do. Today, people walk up to a computer and they want the computer to answer questions for them, but we drove it the other way. We wanted the computers to do work for us.
It's fascinating. The basis of Bollinger Bands is trend and volatility.
Absolutely.
Tell us a little about your indicators. You have three you mentioned to me that you use as your secret sauce.
Well, I don't know if it's a secret sauce. It's pretty public, but I use Bollinger Bands, which are a type of trading band that is driven by volatility. So it's the defaults are a 20-day moving average, and the upper band is 2 standard deviations of the same data that you use to calculate the moving average, plotted above, and then the same interval plotted below. And so those bands, like all bands, many types, Donchian bands, percentage bands, Keltner bands, et cetera, they all answer the same question. They all answer the question as to whether prices are relatively high or relatively low. You can then use that information to create trading systems and define trading approaches. But when I started, we had an assumption about volatility. We thought that volatility was stable, like the sky is blue or the house is white. For example, we thought IBM's beta, which is a measure of volatility, was 1.1. And that was it. We calculated it once a year using 5 years of weekly data because we didn't think that it changed much. But I was an option trader, so I was very lucky. I had an early computer. And one day I copied a formula for volatility down a column of data, and I saw that it was changing a lot. We had been searching for a way to automate the changes in trading bands because, we would mostly use percentage trading bands in those days. So as the regime changed, you'd have to tighten the bands or expand the bands. And when you did so, you'd let emotions into the process. If you were bullish, you'd draw the bands to present a bullish picture. If you're bearish. So I really wanted to avoid that. And I was looking for a way to automate the setting of the width of the bands. And I saw volatility changing, and I thought, aha, that might be it. And it turned out that it was exactly the right way to make trading bands adaptive.
The aha moment. Correct.
Yeah, exactly. And it earned a Nobel, not for me. It earned a Nobel for Robert Engel about 10 years ago. The Nobel Committee recognized how important that observation that volatility was volatile was. He did work on inflation in the very early 80s, and it was exactly the same time that I did my work on Bollinger Bands. So what it was is that was in the air. People were beginning to question those assumptions, and it's that questioning process that's so important.
That leads me into something that I think is really important right now. There's a lot of assumptions, things that people, quote, know in the markets these days. And I have a list of 6 of them that I thought we could discuss, and you can give me your opinion on things that people just assume are the standard. So let's go right into indexing.
Well, to start with, my idea is to question everything.
Right.
And I think that's what everybody should do. You should look at all these ideas that are out there and question everything. For instance, indexing has byproducts that people don't really recognize. The more you index, the more you weld the prices of all securities together. So if you start indexing something like the OEX, which has 100 stocks in it, when you buy or sell that basket, you move all 100 at the same time. That's what I mean by welding them together. But now you start indexing the S&P 500, and it's 500 stocks. You start indexing the Russell 1000, 2000, or 3000, and you're really indexing the whole market, just gluing the whole thing together. So out of that, comes a sort of destruction of diversification. Right, and that's one of the things that I think people should be questioning is the benefits of this diversification. And we've seen, as we saw in the 2006, 7, and 8 period, when the market came under real pressure, correlations for virtually all investable assets merged on one. And what we mean by that is that everything went down together, even things that weren't supposed to, because professionals, when they come under pressure, if they can't sell what it is they need to sell, they sell something else. They sell whatever they can sell.
Right. So diversification was another one that that people say it's great to be. You got to be diversified. It works well when everything's going up, but when it's going down, like you said, correlation is all together and there's nowhere to hide.
Right, and that's really, I think, a byproduct of this sort of mania for indexing. The whole thing was 10, 15 years ago. The idea was that if you just invested in the market, if you just bought the S&P 500, you were entitled to earn 8, 9, 10% a year for the rest of your life for the act of having index. Well, we all know the market doesn't actually work that way, and so it came into circa 2000, and an entire generation of people who were facing retirement over the next 10 or 15 years, the baby boomers, made that assumption, right? They bought those index funds and they said, if I go up at 8% per year for the next 15 years, I'm gonna have everything I need to retire. Well, the market didn't cooperate. It went sideways for 15 years. And so it didn't deliver virtually any returns. Well, it delivered a little bit of dividend income, but it didn't deliver the 8, 9, 10% that many people had promised that they would earn if they indexed. So, these assumptions, I think that they're very dangerous, and it's very important that we question them. It's very easy to say index and you'll be safe, but it's a bigger question than that.
Well, one of the things that a lot you see on TV and you hear from everyone, the market's having a great year. But if you go year over year, and here we are at the end of October, if you go back a month, the S&P was basically flat for a 12-month period. Now, your concern with indexing is if things go sideways, or let's say they go down, that's a large risk for the average investor. And now the average investor, another thing, ETFs are safe.
Well, yeah. So one of the things that indexing has done, and I don't think people realize yet, and it's the same story with ETFs, is it's made stock picking more attractive. Right, when the market's going sideways over the past time frame, as you suggested, there were many opportunities in individual stocks to make a better than market return, and many professional managers, many hedges, and many just ordinary investors, people who still thought about investing in individual stocks rather than in indexes or funds of various sorts, they were able to do very well over the past year. But on average, the returns just weren't there. I think there's a really good aspect to ETFs. the ability to buy like individual sectors or very specialized pieces of the market and experience that return chain that ETFs can offer, I think that's a fabulous opportunity for investors. And if they go after that wisely, I think that that can be a tremendous benefit. But this sort of panacea idea, buy an ETF and you'll be okay. Well, not so much.
Well, there's another thing too, that an assumption. Liquidity is great in the market.
Well, yeah, liquidity is great in the market, isn't it? But it's only great until it's not great, as we saw as we saw so clearly in the 2006, 2007, 2008 sequence. There were times when you really couldn't sell anything. It just wasn't possible. There were not bids. So it seemed like a very liquid market because the volumes were there. But, the volumes were created by people engaging in capitulation. I don't think people normally think of capitulation and liquidity in the same breath. But I think they should. So the idea that liquidity will be there when you need it, I think that's probably a false idea, and that you ought to be ready to field some defense when the going gets rough, before the going gets rough, that is. And I think, this idea that market timing is somehow not a reputable idea, I think that's crazy. I think you have to engage in market timing. You have to recognize times when the risks are increasing and the dangers are building up, especially in these days with all this index going on and all these securities welded together.
Yeah, I would agree 100% with your thoughts on the sectors, because sectors will rotate, and that's a natural thing throughout the year. You'll see technology go up and go down. You'll see the energy market especially is a very good one.
Yeah.
So I think that's really important. And I'm a market timer as well, so I 100% agree.
Yeah, I don't understand why market timing is in disrepute. I think it's an essential discipline. I don't think that means that you buy 100% today and sell 100% tomorrow, which is what some people think market timing is. But I think good market timers recognize when risks are increasing and some money ought to be taken off the table, or as we often say on the street, we ought to get a little closer to home.
Yeah, exactly. Okay, one other thing that I have thought about, and it's an important day today because the Fed's meeting. Don't fight the Fed.
Well, that was one of Marty Zweig's two big maxims: don't fight the Fed and don't fight the tape. Both of which, in their time, were, they were perfect. I mean, they described, the best set of behaviors in relation to the market that could be imagined. But in this last interest rate cycle with zero interest rates, I think that don't fight the Fed part of it has been called into question pretty dramatically. We found, in certain environments that falling interest rates are in fact not a good scenario for stocks, and that in fact rising interest rates might be a good scenario for stocks. That's sort of the opposite of the perceived wisdom. And it also done a lot of damage to academic theory. For example, what is the Sharpe ratio when interest rates are zero?
You can't calculate it.
I mean, it's so. I think these are very challenging times in which you need to look at the realities of the marketplace and keep yourself attuned to them. Another example is this has been a very bad news year, right? We've had tremendously volatile news, good, bad, et cetera, virtually continuous news cycle of stuff that upset people, made people uncomfortable, made people unhappy. Yet on balance, the market's done okay through this. You couldn't have convinced anybody, say 5 years ago, that if we went through this news cycle, stocks would actually be trying to break out, which is what they're doing now. You would have thought that it would have created a bear market. So
it's been this ping pong battle over the 50-day moving average, back and forth with tweets and
just like that
and everything. Okay, let's talk a little about current times right now, what do you think of some markets, like the U.S. markets? Do you have anything to talk about? Rates?
Well, there's a whole bunch to talk about. So a lot of people are trying to hide in bonds right now. And bonds have the worst risk-reward ratios that you can imagine, right? I mean, what's the upside for buying a bond now? You get a couple of percent in income, and if rates continue down, seems highly unlikely since they're near zero to start with, you'll get a tiny bit of capital appreciation. But if rates rise just to historic norms, and you say own a 10-year treasury, you're going to be looking at a 50% decline in the value of your capital. So the potential reward in bonds is very small. The risk, should inflation reignite, I guess nobody believes that it will ever have inflation again, which means that it'll be a show up tomorrow morning. But if inflation should reignite, these bond portfolios that are bought at interest rates of 1% and 2% and 3%, when we go to interest rates of 5%, 6%, 7%, 8%, those portfolios would be destroyed.
Right.
So my whole thesis has always been find trades where the risk and reward ratios are in your favor. For example, with Bollinger Bands, you make a W bottom in relation to the Bollinger Bands, and you can put on trade. You can risk a relatively small amount with a defined potential. Nothing guaranteed about it, but it's defined potential. So you can put on a trade where the risk and reward criteria are in your favor, and the odds of success are also in your favor because you go back and test it, and say, well, this trade works 66% of the time, which is to say 2 out of 3 times, and I risk a few percent, 4 or 5% on the downside, and maybe the rewards 10, 20%. So you have a decent success rate and you have a decent risk reward ratio. That's a positive for investors. That's the sort of thing that you can actually make money with over the years and keep volatility down. The opposite, which is what bonds are now, where risk is huge and reward's tiny. I mean, I think that's suicide. Well, I understand that there's a perceived safetiness in bonds, but I think we ought to question that assumption. It's one of the assumptions.
Yeah, absolutely. The other thing is that makes me just crazy is it's capital appreciation, what bond investors have achieved this year, and nice dividend paying.
By George, lock that in.
Buy stocks for nice high dividends. So when you have the stock market yielding more than the bond market, and bond investors are trying to get capital appreciation, so it's wacky.
So that was that was a holy grail sort of set of indicators, the bond stock ratios and such like that, both for quality and for high quality bonds, for junk bonds, for low price stocks, for high price stocks, so on and so forth. I mean, there's a whole basket of those indicators, and they worked for years and years and years. But in this zero interest rate environment, those indicators are moot. I mean, they just I don't know what they mean in this environment, but they don't mean what they used to mean. So it's not to say that they're not worthwhile, that they're not generating information, but it's not the information that they used to generate. So if you try to operate those on the old rules, you're going to get your clock cleaned. But there may, in fact, be uses for that information in this new environment. I just haven't explored that.
Well, the Fed will, in a few hours from now, and when everybody watches this, they'll know they cut another 25 basis points. Is it just mind-boggling to you that they're cutting rates at S&P 3,000 all-time highs? Low unemployment.
It's not so much mind-boggling that they're doing that. What's mind-boggling is the sequence of rate rises that preceded this, which were totally unnecessary. Right? And their excuse was that, we want to get rates up to a point so that we have some ammunition should we need it. Really? I mean, is that the way you run monetary policy? We want to make sure that we got a stack of bullets here, and I mean, that's not. I didn't think that was the job of the Fed. I didn't, and so I think that sequence of rate rises forced them into this sequence of declines. And I agree with you. They should not be in the situation of having to cut rates into into a very high valuation environment. I mean, I think the latest GDP indication we just got was 1.9%. That's not negative GDP, right? I mean, those aren't recession numbers. That's not back-to-back negative quarters of GDP, which is what the Fed ought to be fighting with lower rates.
Right, and unemployment at 3.5%, and it's just really.
So 10, 15 years ago, my thing that I argued was the most important thing was not the unemployment rate, but the total percentage of the U.S. population that was working, the employment rate. And that had declined dramatically for many years, and then went through a static period. That's now rising, right?
Yeah.
As you point out, 3.5% unemployment. But you can look on the other side of that, and that number looks very good as well. After a long time where that number looked hopeless for the future. So more and more people being employed as a percent of the population, I think that's a very positive trend. I don't think anybody's talking about that.
Yeah, I think you're right. Well, I want to wrap it up with a question on what you think is the most pressing issue right now for investors in the market. Well,
I think the most pressing issue is the same issue that it always is. It's discipline. We too many people invest in an undisciplined manner. We have to have a rigorous, rational approach to investing, and we have to employ it come whatever the market does. I think that these assumptions that we should index or somehow that we don't have to take responsibility for investing. The typical man or woman out there has a job. They may probably have a partner. They might have a family. They're trying to put together a future. So they're generating some income, and they're putting into savings. Well, investing is part of their job, and they need to realize that. So you have two choices. Either you can do it yourself, or you can pay somebody to do it for you, an investment manager, and you can examine their track record and their discipline and what their ideas are and see if it suits you and suits your approach. But this idea that somehow that they're just returns that come to you from the fact of investing, not so much.
Yeah,
it's work. It's a job, and it has to be done, and it has to be done with discipline.
It's going to get harder out there.
Yeah, I think it will. These are extraordinary times. These zero interest rate environment that we're in, we've never seen anything like it before, and we have to really pay very close attention to what's happening. There are real risks out there, but there are real opportunities out there. I'm not a Cassandra in any way whatsoever. I'm actually very bullish on equities here. I think stocks are going to do well for quite a while. I mean, at least into the end of the year and early into next year. So I'm not a Cassandra. I just think that we need to do some work.
Well, I'll leave it at that. John, it was great to meet you. Thank you for coming on Real Vision. So everyone, I just want to say thank you for having me. I feel honored to interview John, and we'll see you again soon.